Is stock trading just another form of gambling? Well, there's some things to think about that separate those who gamble from those who really trade, and I'll talk about what those are. Plus, I'm going to take a look at the overall market. We've had some pretty good gains so far in 2023. Are they likely to continue, or is this just a little bear market rally? And then finally, we're going to look at the day trade of the week on GFAI. So, is stock market trading actually gambling? I've had many people say that day trading and short-term trading of the stock market is nothing more than gambling. It's making the stock market the world's largest casino. So the question is it really gambling? And there's actually a simple way to answer this question. For some it is and some it isn't. That's the short answer. But what differentiates those who are gambling with those who are not? Well, it comes down to expected value. And in that, you must understand this concept of strategy trading versus reckless throwing money in the stock market based on a tip. So when we talk about strategy trading, what it is really is having a set of rules or guidelines that determine when you will buy and when you will sell. And from that, testing it over a large sample size of past trades or even future trades, testing it, and coming up with the economics of the strategy. So if you do 100 trades and you make money on 50 and you lose on 50, some would say, well, that's gambling because you're not right more than you are wrong. Well, actually, that's not true. Because what if on 50 of your trades, you make $1,000 each on average, and on the 50 losing trades, you lose $500 on average? Because you're analyzing 100 trades, a large sample size, and because you make $50,000 on your losers, on your winners, and lose $25,000, overall you've made $25,000 after doing 100 trades. That means your strategy behind those 100 trades has a positive expected value. Now, if you go into any casino, there is no game in the casino that has a positive expected value. There are some people who can count cards in the game of blackjack and barely put the odds in their favor, but of course eventually the casino figures out what they're doing and it kicks them out. Now if we go back to our strategy where we have 100 trades, I talked about this recently, you could have 70 winners and 30 losers. And you might say, well, that is not gambling because you're making more often than you are losing. But if 70% of the time you lose $1,000 and 30% of the time, if 70% of the time you make $1,000 and 30% of the time you lose $3,000, then are you really making any money after you do 100 trades? No, because 70% of the time you make $1,000, so that's $70,000. 30% of the time you lose $3,000, so that's $90,000 in losses. So after a large sample size of trades, you've actually lost $20,000. That is gambling. Doing something that has a negative expected value is gambling. And so your approach to the market, if you intend to be a trader, is to make sure that you have a well thought out, well-defined strategy that has a positive expected value, that you've tested that strategy not only over a large number of trades, but also over a wide variety of trading conditions. Does it work in a bull market? Does it work in a bear market? Do you do a different strategy in a bull market versus what you do in a bear market? So if you can do those things, if you can take out the recklessness, if you can have a set of rules for when to take your profits and a set of rules for when to take your losses, that means you're that much closer to being a real professional stock trader and not a gambler. All right, let's get into this week's market analysis. We had good gains this week after the US Federal Reserve raised interest rates a quarter point, but the market liked the commentary that came from Fed Chair Jerome Powell, and we saw a good rally on that ran into the end of the week. Friday, the markets took a little bit of a breather, but overall the markets were up nicely. Let's jump into the chart of the S&P 500 to determine whether this strength is likely to continue. So here you can see that weekly chart of the S&P 500, and I'm going to draw a trend line here across these tops. You can see that we have broken the downward trend line. We talked about this last week because last week we broke it for the first time. Volume was light the week before, but this week it's a little stronger. And most importantly, we've got a rising bottom before the break of the downward trend line. So optimism, we've switched from pessimism to optimism, and we've broken the downward trend line. That is a strong signal that the buyers have taken back control of the large cap stocks in the US. Also notice that the Stockscore indicators have risen back above that all-important 60 level. If you look at the time here when the market was really rallying well, this was after the COVID crash, that entire time our stock scores were strong except for this little brief period for about 2 months when the market went sideways. So looking for that sentiment stock score, which is the green line on the chart that you see, is a real good indication of whether the buyers are in control or the sellers are in control. And the buyers have taken back control of the market after really the sellers being in control for all of 2022. So that's a big step for the market. Now let's take a look at the short-term chart, more for the swing traders and day traders. You can see here that the trend is up. We are in an upward sloping channel. We got a little extended to the upside on Thursday. There's the Fed announcement reaction. And so it's pretty reasonable that we'll pull back a little bit here in the short term. But unless we break this upward trend line, we should be good in the short term as well. All right, let's jump over to the Canadian market. T.XIU is the symbol for the TSX 60. Here is the daily chart. You can see the buyers are in control. We have rising bottoms. You can draw a trend line. That's positive. We broke through horizontal resistance there. When we look at the 3-year chart, you can see that we have made that bottoming head and shoulders pattern. We've broken out. The only issue here is there's not a lot of upside until we get to resistance. The TSX didn't suffer as much as the US markets because of the heavy contingency of mining stocks and oil and gas stocks, which are sectors that have done fairly well. So the upside isn't as much, but it also didn't suffer as much on the downside. Let's take a look at gold because it had an important move this week. You can see the reaction of gold following the Fed has been downward. And so we have broken the upward trend line on the daily chart. Now, it did that from a new high, not from a falling top. So it typically will come back up a little bit, make a falling top, and roll over. So you'd want to watch for that as maybe a little bit of a sucker rally. Don't be sucked into a little bit of strength in the short term, because unless it breaks through that high, the sellers are starting to take control. Now let's take a look at the 3-year chart of gold. And you can see that we had this great run for 3 months or so, maybe 4 months, and we've come into this resistance zone from old highs, and that's why we're getting stuck there. So I don't know that gold is necessarily in bad shape. It just looks like it's stopped going up. Will it start to go down? We'll have to see how things develop in the next little while. Let's jump now to a chart of oil. There's a number of ETFs for oil. We're going to use BNO, which is Brent oil. This is an ETF that trades on the Amex. Let's take a look at the 3-year chart, and you can see that we've got the upward trend line there, and we've been dancing along it. But what's important is we've been building these falling tops. We still have rising bottoms in the very long term, but we could break that. So it's a really important point right now. This is what's called a pennant. And if we break down out of this pennant next week, things could get ugly for oil. You see that the sentiment stock score is quite low, and that is because we've been in this trending, downward trending market for the last 8 months or so. However, we haven't broken the upward trend line in a strong way just yet, but we're very close to doing so. I want you to be cautious with oil and oil stocks. If we look at the short-term chart, we were trying to recover a little bit, and then this week we just gave it back again. Now, one of the reasons is the US dollar, which had a pretty good spike this week. It's been stabilizing for the last 3 or 4 weeks, and then on Friday it broke higher. And so if you look at that on a short-term chart, you can see that the cycle of falling tops on the short-term chart of the US dollar has been broken, and we may now start to see some rising bottoms. Well, a stronger US dollar makes things like gold and oil, which are priced in US dollars, more expensive, and that can be a problem for those commodities. So that's one of the reasons why we're seeing that weakness in commodities. Now let's take a look at Bitcoin, which is a very alternative to the US dollar. GBTC is the symbol of that ETF. It had a good comeback rally in the early part of January, and now it's kind of stalling. Not a bad pattern, but if we look at the long-term chart, you can see that it's really dismal still. So I don't want anyone to get too optimistic yet. It is potentially building its first rising bottom, but it needs to break through this level here. So if it can have a strong week up, then I'm going to start to feel a little bit more optimistic about Bitcoin. Now, in the short term, you've got rising bottoms, buyers are in control, and so for a short-term trader, either in the cryptocurrency itself or in some of the miners that are out there, the crypto miners, things look okay. But longer term, it's still an uphill battle, so don't get too optimistic long term just yet. Let's talk about interest rates. Of course, the Fed made a small raise of rates, but really not anything more than expected. And so you can see that the chart of interest rates is down. It is testing support. We could see it break down further. This, of course, is not the chart of interest rates, but it's an inverse ETF of the Treasury bond market. So typically, if this is going down, that means interest rates are going down. You can see that the big rise in rates there, and we've given back a lot of those gains. And so the market pricing in or expecting that rising rates is not going to be there. And so if you're thinking about getting some debt, you might just want to wait a bit because the bond market is predicting that interest rates may cool off even further. All right, and then final chart we're going to look at this week is VXX, which is the volatility ETF. It's really only useful to look at this in the very short term. And you can see that volatility has been declining, but it started to pick up a little bit. So this is one to maybe watch if it can break to the upside here. We might get a little bit more downside volatility in the market. No real reason for concern yet, but just something to keep an eye out for. I like to always keep an eye on this chart. But again, don't look at the long-term chart because the long-term chart of VXX and the other volatility ETFs and ETNs is always has this rebalancing effect. So it erodes in value over time. There's time value decay, much like an option or a futures contract. All right, so let's get into my ratings then. US stocks bullish on both time frames. Canadian stocks, I've only got it on neutral in the long term because of that limited upside, but bullish short term. Lowered my ratings on gold to neutral on both time frames. The same for oil. US dollar neutral on both time frames. Bitcoin short term bullish, but still long-term neutral. It's trying to bottom, but it hasn't given us a strong signal yet. And interest rates, long-term neutral and short-term bearish. All right, so let's take a look at the day trade of the week. Of course, every day on Stockscores, we have a webinar that runs during market hours called Active Live, where you can watch my analysis screen, running algorithms, looking for opportunities. It's all computer generated. And then my commentary in addition to that, and reviewing trades, teaching, all of that's part of Active Live. You can learn more about that on Stockscores. And this is just an example of a stock that we found on Friday with the help of the computers that I utilize. And this is a strategy I have called a pullback play. It looks for an action candle, which is this little yellow dot right there. Action candle out of the right pattern, breaking a pullback on a stock that is abnormal. And these are called risk reward lines. And so we never plan a certain upside, we just let it run. And this one ran in a nice linear upward trend right into the close. So this is one that you could hold right from the entry point, which was just about 20 after 12 Eastern time, right until the end of the day. And you can see that at the end of the day, it says there 1,100%. That's basically 10 times risk. So if you risk $100, this makes $1,000. If you risk $1,000, this makes $10,000. So 10 times risk is a really great trade. Friday was a little bit of a quiet day, so happy to see that happen on Friday in this particular stock. There's a few more as well. If you want to learn more about that, go to stockscores.com. If you enjoyed this week's video, put a thumbs up there. If you have some comments on some things that you would like me to cover in future videos, leave those in the comments, and I'll try to fit some of those in. Subscribe to the channel if you're not already. Make sure you click on the notifications bell. But most importantly, trade well.